Welcome, everyone, to the ClearVista Financial market update for April 23. We have gone through a quarter of the year, and a lot of things have been happening and not a lot of resolution in what's been going on with the markets. I'm here today joined by Jesse Hamilton.
Hey, welcome.
Yeah, welcome to everybody. So this is ClearVista Financial Perspectives. We do this on a monthly basis on the first Thursday of the month, and we're glad that you've chosen to join us here for a few minutes today. So Jesse, why don't we outline our agenda for today?
Great. So first, we're going to go over our index performance for the first quarter of 2023, just as always. And I think we'll get a look at the volatility that we've been dealing with so far this year. And then we'll talk about our market commentary and the recent chaos with the banking sector and Silicon Valley Bank. And then at the end, we'll be happy to answer your questions. But I think for now, we'll probably close our video down so that you can have a little more space to look at our slides.
All right, we'll do that. Okay, let's jump in.
Great. So we'll start off with the S&P 500, which is the large cap stocks. And that index is plus 7.05% year to date, but we're dealing with a very volatile index here, plus 3.57 in the month of March. And you'll see the February 2nd peak through the March 13th trough were minus 9.21. So that's quite a swing.
Yeah, and that's just giving us signs that there's still going to be a lot of bumpiness left in the market,
right?
As we come out of this. You know, I think that 4,100 level is really important. I think today on this recording, we're trading below 4,100.
Right.
January was showing a lot of signs of strength in the market. We were seeing, interestingly, we were seeing the major indexes going up, and we also were seeing bonds going up at the same time. And that shouldn't be happening.
Right.
Right. But nonetheless, we peaked on, what was it, April or February the 2nd?
February 2nd.
Yeah. And then we rolled over again, and that was what, about a 9 or 10%?
Yeah, 9.2.
Yeah. So we've still got some ways to go. We think this is going to continue to bottom along here for a while, up months, down months, and so forth. And we'll get into that later in our presentation.
Right. So here's the NASDAQ, which is a fascinating thing that's happening right now. The index itself is actually up 16.8% year to date, but we're going to talk in a little bit about why this is happening. The March rally is really fueled by 6 companies. We'll talk about that in a minute.
Okay.
But the volatility that we're discussing here, the same February 2nd peak to trough is minus 10.49. And we're dealing with similar support and resistance here, but this is an index that's known to be pretty volatile.
Yeah. What about small caps, Jesse?
Yeah, the Russell 2000 is our small cap index. It's plus 2.82% year to date, but that's part of a greater picture that's not showing very much strength. It rallied in January like the rest, and it's minus 5.2 during the month of March. And what we're dealing with is the biggest peak to trough of all the indexes this year. February 2nd to March 13th was minus 15.96.
Yeah, and you really need to see small cap companies really rise up as well. In fact, when you have a healthy market, you're going to see all sizes of companies going up as well. We have not seen that with small caps after the February peak.
Right.
And so that's concerning. The breadth in the market's not there. We're going to get into a little bit more in the presentation today.
Right.
So what about long-term treasuries, Jesse?
So this is also an interesting chart. We're dealing with a plus 6.8% year to date, which sounds great, right? And it's actually positive in the month of,
especially when long-term bonds went down 40% at one point.
Yeah,
last year.
exactly.
Yes.
But you'll notice the exact same peak and a little bit sooner trough on March the 2nd. So exactly a month apart. This index dropped 9.5%. That's a lot for bonds.
Absolutely. It's a huge move. And that was because we saw interest rates rising up as well. But also, too, we had the banking crisis there in the middle.
Right. So the next chart here is the 6-month trailing. We always like to do this on ClearVista perspectives. You can see the October low, the February high. This gives perspective on the volatility that we've been doing with this quarter. So I drew that red line there at 4,100. That's been a key resistance over the last 6 months. You'll see it bounced off there and then it briefly went above it in February. We'll continue to use this line in the coming weeks to determine momentum in the market, right?
Right, and this was a pretty good signal here coming out of January that it broke above that resistance level. And if you had talked with us in January, we were focused on that then. We rolled over in February and March quite significantly there in the early part of March.
Right.
We've since rolled up above that. But as of this recording today, when we're presenting this webinar with you all, we said that price is below that 4,100 number right now. So that seems to be the line of demarcation that we need to stay above, and the S&P 500 has not been able to do that. Go ahead.
Exactly.
Jesse.
Well, the good thing about this pattern is it could be the beginning of a bottom in the market. We don't know that for sure, but it just means a floor where the index is unlikely to fall below moving forward. And we definitely can't predict the future, but these technical patterns can provide some overall insight and sentiment.
Mm-hmm.
And if we do have another sell-off this month, the consolidation pattern there in December, where there's a lot of candles right next to each other.
Let me get that. So I highlight that for everybody here.
Yeah, that's going to be a key support level if we do sell off again this month.
Right here in this bottoming part here in December. We actually got very close to it, and toward the 1st of March there, we rebounded off that. We may see that roll over again,
right,
and test that support. If we test that again, those March lows again, and we stay above that, I think that's a very positive sign for the market. But like I said, I think we're going to continue to see a lot of bumpiness along the way.
Yeah. So for our next segment, we're going to do our market commentary, which is where we're going to talk about what's really going on within these indexes and the market as a whole. But
all right,
Mark, take it over. This is our first slide here, the consecutive days since all-time highs.
Yeah, so this has to do with the depth and the length of a bear market, because what we really are focusing on is how long does it take to rebound to where we were before the sell-off began. Now remember, the S&P 500, that all-time high was on January 4th in the
of last year
in 2022. In the NASDAQ, that was actually in November of 2021, and that time there. So we're looking at this time as of just a few days ago. It's been about over 300 days since we had this S&P 500 set on the new all-time high. Well, let's go back, okay? Because I want people to put this into perspective and realize how long it can take to get back to where we were and recapture the gains that we had before. Let's go back to the great financial crisis, 07 to 08.
Mm-hmm.
It took nearly, a little over 5 years for the S&P 500 to get back to where it was in October of 2007.
Yeah, wow, that's a long time.
2012, 2013, before we saw that recover in that period. Now, I'm looking in here, I can't zoom on the chart that well. Yeah, if we go back, and that was actually 1,300 or so days, more than 1,300 days, almost 1,400 days in the great financial crisis. Going back to the tech bubble in the early 2000s, that took many years to get back to normal. Over, if I look at it correctly, I want to say it was easily almost 1,800 days.
Yeah.
And to get and stay above that was almost 13 years before we saw that recovery.
Right.
So
the smallest triangle there on the bottom right just shows that the 300 days is the longest that we've had since the great
right. And you can see we have little peaks and triangles there, but this is just really beginning to recover. This is not like we had in the beginning of the pandemic when we had that recover very quickly. We went down 37% in 1 month and we rocketed back up. I think that was a different situation this time, and I think it's different as well. Let's talk a little bit about treasuries and the yield curve. Now, we discussed last month in our update about the inverted yield curve as a precursor to recession. Well, we still have that. Almost in every recession in our history in the United States, the yield curve inverts prior to a recession.
So what does it mean by inverted?
Well, let me draw on here. I'll draw the little highlighter here. In fact, I think I can probably go over here and just draw a little line here. I have no idea what color it's going to be, but a normal yield curve looks something like, and I'm running into my microphone, looks something like that. It should be a straight line or a curved, smooth line. But that is what we would normally see. This normal curve here comes out like this, where you have long-term treasuries out on the 30-year treasuries. Those are up higher. The lower short-term treasuries, like the 1 to 3 month T-bills, should be lower on the curve. And what we're seeing is the exact opposite. Now, this does not mean that it's certain we're having a recession, but based on the data that we're looking around right now, we think that is still to come. You'll see that 6-month yield is around 5% up here. And you also see the 30 yield is under 4. And this changes every day. We look at this every day. We see how it's changing. There's been some movement in the short end of the spectrum and the long-term spectrum. But the big thing is we're still seeing, I think this was the end of the month, wasn't it, Jeff?
Yeah, that's
10-year treasuries are falling again. But that's not necessarily a good sign necessarily. Okay. So it's something we just watch. We're using a number of different tools to make sure we're still investing in bonds and capacity, but we're probably holding towards the shorter end of that yield curve versus the longer term yield curve. Now let's look at this is what we were talking about earlier when we talked about the breadth of the market. Okay. Now, through the first part of January into February, we saw the cap weighted S&P 500. That's what you see when you hear on the news. You hear about the S&P 500. That is cap weighting, meaning that the larger companies in the U.S. Stock market exchange on the S&P 500 carry more weight.
Right.
If they have a good day, the index has a good day. And what we're looking on this chart here is comparing the cap weighted S&P, which is what we hear on the news, and the equal weighted, meaning that for every 500 companies on the S&P 500, each of them has an equal vote.
It's like for you political people, it's the House versus the Senate.
Yeah, exactly. So California and Texas have more weight in the House, but everybody in the Senate is equal with 2 votes per state, and that's it. So equal weight, 1 vote for every company. So these larger companies have a larger pull on the index. Now, what we're watching here is an interesting divergence, okay? Up until the first week of March, these were kind of tracking together. That's showing some health in the market. But it also means that after that, in the latter part of March, we're seeing that the S&P 500 rose and diverged from the equal weighted index.
Right.
Now, in fact, the equal weighted index was actually negative, and that's why a lot of your small caps and smaller and mid-sized companies were actually negative in the first quarter versus the large cap. But what we're really looking at here is this index is really becoming more like, I'm going to make it up here, the S&P, not the S&P 500, but the S&P 6.
Okay.
It gives the index a facade that really makes these things skew and explains what's going on with just a select few companies.
Right.
So think of drinking a cup of coffee or energy drink when you're tired or exhausted. It might give you a short-term feeling of energy, but you're still needing to rest.
Right.
And so those 6 companies are the big mega caps. And now we're not recommending any of these companies. We're just telling you these are the 6 largest companies in the index.
Right. And they're running the market right now.
They are driving the market. So when you see the index go up or down, what you're seeing is what's happening with these 6 companies.
Yeah.
It's not a true picture of what's really going on in the market. Now, we grabbed this screenshot from one of the financial channels this last week, and you've seen a $600 billion rally in March with just these 6 companies, okay? And it's important. Because if something happens to one of these, it's going to bring down all the indexes. What we're watching right now is in the next few weeks, we've got the earnings season starting next week.
Right.
We'll also, tomorrow on Friday, the 7th, we will actually get the jobs report. We're thinking that the Fed's going to see this as it's still overheated. And that might help them continue to make a decision about whether to raise or keep interest rates at a pause.
Mm-hmm.
But we're not seeing the breadth of strength in the market as a whole. And what looks like a strong first quarter has really been 6 companies.
Yeah.
All right. So it's important to realize that if your portfolio is not tracking the S&P 500, it may be because of these 6 companies. And that's okay. When we don't see the overall breadth in the market, we don't get the rising tide that raises all the ships. Because we've been seeing the last few days of the first part of April, we've been seeing the markets roll over again.
Yeah, we have.
And it's because these 6 companies, and I suspect that their earnings are going to come out next week, and we'll find out what they give us a good indication of what the economic future might look like.
Right.
So, Jesse, you were telling me the other day, we were talking to one of our supporting coaches that we use for market analysis and things, and you made a comment.
Yeah, he said that when you go to the doctor for any reason, the first thing they do is check your heart and your breathing and your blood pressure to look at your vitals, right?
Yeah.
So that simple examination often explains why a lot of things are going wrong. And so it's kind of like this in the market right now, where a lot of people want to focus on one specific issue or think this one thing is driving, but whether we're headed for a bull market territory or whatnot, but we need to check the vitals. And this is just not the sign of a healthy market.
Right. We don't think the market is very healthy right now. And, don't listen to the news commentary, because they were real quick at the end of March to say the bear market and the NASDAQ's over.
Right.
That is an arbitrary number that they're pulling. They're seeing it come up 20% from the low back in October, but we're nowhere near that all-time high that we had in November of 2021. Okay. So we're just asking you to pay attention to these things. Here's another comparison chart that we use. We're comparing growth versus value. If the market's taking off, growth is doing really well. And so this little line here, the black line, is what we want you to focus on here. When growth is in control and growth is doing well, the black line should be going up. But what you can see over the last several months is the black line's been going down, meaning that value companies, those companies that have been around for a long time, were doing better at that time. That's kind of turned around the first couple of months, but we're rolling over again. So a growth company would be newer companies. I'm thinking about newer companies, but some of the mega 6 mega caps they're considered growth because they are newer, even though they haven't been around but for maybe 20 years or so. They're much younger than, say, a Dow Chemical or anything like that.
Yeah, they're interested in expanding their business at all costs. Right.
They want to hold less cash. They're going to take more risk, and they tend to move faster than others. So value companies are those companies that have been around longer and have been proven over many years that they're a stable business and they have household names that you're likely to recognize and they'll stick around. But that black line is kind of telling us what's going on here. What's been happening in the last several weeks has been growth has been kind of coming back, but now it's rolling over again. So we want to be careful about that to make sure that we realize this is not a breadth. This is a breadth issue in the market. We're not seeing the breadth in the market, which is a signal of a healthy market for that. So we're going to watch that in the coming weeks and stuff. Here's another vital that we're focused on right now. Well, this little table here shows that it took the United States 215 years.
This one's kind of scary, but
yes, 215 years to rack up $7 trillion in debt. And that happened in the early 2000s.
For reference, that's George Washington to George W. Bush.
Okay, George Washington, George W. Bush. We had Herbert Walker Bush. So
yeah,
HW. So HW Bush, $7 trillion, 215 years. And since the early 2000s, we have racked up another $23 trillion in debt. And more specifically, and since the March of 2020, we have added another $7 trillion in debt, where our debt level is getting close to $30+ trillion. Now, this is not a virus of our credit-based monetary system. It's a feature. And I think that the virus is about to become a virus because it's going to be expanding and growing even more. So the debate about raising the debt ceiling this time isn't the same as it's been the last past few decades. If we continue to raise the debt ceiling and allow the government to spend more and more money unchecked, it is ignoring the mistakes that were made when we were trying to address COVID. This is not an incremental issue of just simply adding a few $1 trillion to the debt level. It is of historic magnitude. And because these problems are going to compound dramatically over the next several years, especially as we're having rising interest rates.
Right.
That means that new debt that the U.S. government is taking on is going to be costing more to service. And pretty soon, next month, I think we'll put a chart up here about how much of the federal debt every year is simply to debt servicing, or how much of the federal budget every year is simply to debt servicing. This is a problem, folks, and it's going to come home to roost. It may not affect your generation, but it will affect your grandchildren's generation and their children's generation. So this is a big problem that will weigh down on the economy.
Yep.
So let's talk about banking for a little bit. A lot of news a lot of news about failing banks and things, and we've been getting lots of calls.
Yeah, if we were a news channel, we would lead with this because that's what everybody wants to hear.
Yeah, and the reality is, here's what happened. Silicon Valley Bank, and I still have friends that used to work there. They don't anymore. Silicon Valley Bank collapsed on Friday, March 10th. There was a run on the bank on Wednesday and Thursday of that week, and it was the second biggest bank failure in U.S. history. And so that run on deposits, they doomed that tech-focused lenders' plans to raise fresh capital. They were trying to work it out.
A lot of tech companies store even their balance for paying their employees.
Payroll, everything, venture capitalists use that.
As well as high net worth CEOs and stuff.
So it was a problem. So now we sent out a newsletter in early March that explained it in more detail, but it still seems to be something that people are worrying about. It does feel similar to 2007 and 2008, even though it really is a completely different scenario than then.
Right. It might feel the same, but we're dealing with a different ball.
Right. So let's talk about that just a little bit. Okay. So let's examine in bank runs and so forth. So there's always risk when you're dealing with any financial instruments, securities, bonds, even bank accounts. Risk changes all the time. And no one was thinking about a bank run would be a legitimate risk in 2023.
Yeah,
right.
It was not on anybody's radar.
Nobody's radar. Now, back in 1929, bank runs meant waiting in line outside your credit union or your bank,
Yeah,
and
you might actually need to run.
You would go, you would run to the bank, right? You would run to your bank, stand in line. When you get to talk to a teller, they're not letting you get as much money out as you want, as you have in the accounts, but you're going to get out what you can take
in cash
and
run
and run back home. Now, the Silicon Valley Bank run was completely different because billions of dollars were moved out of SVB accounts in a number of hours.
Yeah.
Right. The bank runs in the late 20s, early 30s took several months to happen and days to happen. But this happened in a few hours. The reason? Technology.
Yep.
Right? Technology allowed the account holders to move billions of dollars on their smartphone in a matter of minutes.
On apps.
On their apps. And in fact, once the word got out, now this is kind of interesting. I think hopefully this will be investigated a little bit. But there were two tech entrepreneurs that knew about this problem with Silicon Valley Bank, and they moved their money out the day before.
Right.
I think it was Tuesday or Wednesday.
High net worth people.
Very high net worth people. That might have chinked a little bit in the armor of Silicon Valley Bank as far as their deposits. But then on the following Wednesday afternoon or Thursday morning, they posted what they did on social media.
Mm-hmm.
Okay. And I don't want to quote who it was because I'm not for certain exactly the two people, but this is what information we've been getting. And within an hour, about 2 hours, right?
Yep.
$42 billion left Silicon Valley Bank. Okay. $42 billion left Silicon Valley Bank. And so they basically had no cash on the balance sheet to be able to pay depositors anymore, and they had to shut their doors. Now, where did that money go? This is one of the main differences besides the technology moving money out.
Right, because we talked about they're not getting a bag of cash and running home.
Exactly, right? They're just moving on their smartphone. Well, where did that money go? So 50% of that went to JP Morgan Chase. JP Morgan is one of those banks that at least consumers feel like is too big to fail, right?
Right. That's not a statement of fact. That is what people think.
That's right. Yeah, it's not a statement of fact. It's what people think. So 50% of that went to a bigger bank. In an old-fashioned bank run on the money, that money left the banking sector altogether.
Yeah.
Right. Back in the 1920s. You took as much money home as you could and you stuffed it in the mattress or put it in your safe at home. Right. Today, almost all the deposits withdrawn from Silicon Valley Bank stayed in the banking sector. They just changed their address.
Yep.
All right. And that's very different from wanting to get money out of every bank. There's still a lot of great deal of confidence with our banks, just not all of them. One of the things that we found in this analysis is that a lot of banks were collecting a lot of deposits in the pandemic because we were getting paid to not to work
and free money from the government.
And so almost every bank's balance sheet was increasing with deposits. Okay. So banks by law have to make sure that they're doing something with their money. They're either loaning it out, or they're investing in things that are aligned with their charter, usually very CD type instruments or treasury bonds that are guaranteed by the federal government. And so what Silicon Valley Bank did, they were doing both of those things. They were loaning money out to very risky tech companies.
Yeah, I think we're going to get some really interesting findings when this comes out.
When this comes out, folks, you're going to find a lot of stuff that you've been thinking probably in your mind about some of the political agendas of certain types of folks, and they're tied to this bank. And the bank also invested in long-term treasuries, right?
Yeah, which we know what happened last year.
30-year treasuries at one point last year were down 40%. So that meant that the balance sheet of that bank went down tremendously from two sources, right? Two sources. And it was just a matter of time before that bank collapsed. I think there's a lot more banks that did the same thing, but they don't have the technology investment component that Silicon Valley Bank did. The other big one that failed, it was the Signature Bank in New York. It was tied very heavily to cryptocurrency, and we've seen some of the scandals that have happened in cryptocurrency there in the last several months.
Well,
okay,
here's the question that everybody's asking, Mark.
Yeah, exactly. Is my money safe? And I believe that our money's still pretty safe.
Okay.
Right? Don't run down to the credit union or your bank to pull your money out. The hard part of these types of questions, though, is we have official rules and regulations. Now, FDIC insurance is for federal banks or state banks, and then credit unions are insured by NCUA, which is the National Credit Union Association. Different type of insurance, kind of similar principle. Well, there's official rules and regulations, and then there's the unspoken rules. Okay.
Right.
What happened with Silicon Valley Bank? Well, depositors that had more than $250,000, because that's the limit.
Yeah, that's the in writing limit.
They should have not gotten more than $250,000 back.
Yeah, but the unspoken rule here is we got to make it work.
We got to prop it up. The federal government's got to prop it up. You and I, the federal government, and we are the owners of the federal government. We propped up the banks. And so over the weekend after the Silicon Valley Bank closed, Janet Yellen announced that the Treasury would make all depositors whole. Of course, we had to print some more money.
Yep.
And I forgot how many $100 billion have been put back into the system in the last several weeks. the opposite of what the Federal Reserve is trying to do.
Exactly.
And this one term will probably cause inflation to creep up again.
But the only rules here are 250, right?
That's right. So the unspoken rule was we're not going to let the big banks fail, but the rule is 250. Now, will they honor that if another bank fails? I don't know. But the precedent's been set, right?
It has.
The precedent's been set. Your bank, you hope, is just too big to fail, right?
Right.
So we don't know what's going to happen. And in fact, there's conflicting information. Janet Yellen, and I had a class with her when I was in grad school and stuff. So I know about her. I don't know her personally, other than she was the professor. But I don't know her personally. But she's flip-flopped on this several times in the last few weeks. And in fact, on the day that the Federal Reserve Chairman, Jerome Powell, came out and talked about raising interest rates 0.25%, which was significant. She was saying that, and Jerome Powell saying that we were going to prop up the banks. She said, well, not every bank at the same time. I mean, within a few minutes of each other in a different speech. So we'll continue to watch this because I think it's something that is going to influence how much money is in the system. The money supply, M2, as we call it. The money supply, M2, as we call it, has increased dramatically in the last 3 or 4 weeks. That's what the problem was with inflation last time. I don't know. We talked about it. We talked about not last month, but we've had the Federal Reserve raise interest rates 0.25 point.
So do people need to be worrying?
No, I don't think so. I don't think this is a situation where you need to go have it run on the bank.
But
so
the bottom line for now is that the U.S. government has your back, right? At least from their actions. All the deposits have been guaranteed in this situation, but until further notice, we could change at any time in any direction. So we do need to exercise some caution here.
Right. So you may just want to look at your accounts and make sure that you're not overly concentrated in one account and you have a bunch of cash in there.
Right.
I know it's something, at least with the credit unions that we work with, it's often a conversation that they have with their members and things about making sure that they have that dispersed in different types of accounts. You may just want to look at that.
But what about balances over 250?
Well, you know, the rule is for most banks is $250,000 per registration, per account, or per individual per account. Trusts are treated a little bit differently and stuff. So just have a conversation with your financial advisor or your banker to discuss that and make sure it's something that you don't need. That now
your advisor might also have alternatives that you could talk about as well.
Yeah, and we've seen because interest rates have been rising, there have been a number of different instances where we can help find our clients, better places to park their cash, right. Lock it up for a short period of time to get a fixed interest rate. Number of different things that we can do with that. So it's just something that you want to talk about with your financial advisor about those alternatives.
So this is a similar slide that we like to end with, but so just what does this mean to you? You know, what do you think, Mark? Well,
we're always navigating these different criteria, different data in the market. You know, starting next week, like I said, tomorrow we'll see the employment report. Starting next week, we'll see the information and data about corporate earnings. Those start to roll in, and that will last for 3 or 4 weeks, and so you'll see the markets react to that things. You know, we just kind of believe there's nothing new under the sun, so we don't want to sound like we're all gloom and doom on the economy. That's the thing I want to make sure. This is why we call it perspectives. It just means that here's the things we're watching for our clients. What does it mean? Well, we encourage you to check your statements, talk to a professional, educate yourself about the markets and things. And then hopefully your professional will help guide you through this process. What we've been seeing, though, a lot, Jesse, is that a lot of folks have been coming to us and say, I haven't heard from my advisor. I don't know what's going on.
Yeah, that's a problem.
Yeah, that is. And you need to make sure that your advisor is talking to you about things. And if they don't have the answers, or if they just give you the responses, don't worry, it'll come back. We
Right.
saw from that previous slide, it might take years for it to come back. You give us a call and we'll give you a second opinion.
Yeah, it's okay if they don't have all the answers right now, but if they're not willing to find you the answer, then that's a problem.
Yeah, it is. So make sure that you're having a good relationship with your advisor there. We'll take questions from the audience. I think you can put them in the Q&A section on the Zoom there.
Yeah.
I'm not seeing any right now, but let's talk about this. So, well, here comes a question here, Jesse. Do you want to take that?
Sure. We mentioned this earlier, but is it safer to hold cash at local banks and credit unions or large banks like BOA or Chase or whatever?
You do what you normally do.
Okay.
I mean, don't move money around and stuff. I would check those balances and things. And if you're over 250 and you consistently hold over 250 in any of those accounts, you might think about, spreading that around somewhere else. And we can help you with some of that stuff if you need suggestions here. Let's take one more question here.
Okay. A lot of people are asking this these days, but what's your opinion on holding physical gold or silver?
Well, it depends on everybody's particular situation, right? I have no problem holding a little gold or silver. We actually sometimes use the electronic version of that in our client portfolios. And so it's really a personal preference, but here's the reality here. If you've got a bar of gold, it is still worthless to use in the economic system until the HEB or the corner 7-Eleven store will cash it in for exchange for products.
You can't fill up your car with a bar of gold?
No, not right now. So realize that it's okay if you want a little bit of that in your portfolio, a very small amount, but you got to make sure that it's not significant, because you can't just go in and cash it in.
Right.
And so, you only want to use that if you've got, it's not going to be used as a currency right now. And and it hasn't been for a while, but some people feel that that's important. Okay, folks, it's real easy to schedule a call with us. You can go to my calendar and look at that, calendly.com/Mark Trice. We can give you a complimentary consultation. You can always give us a call here at the office at 800-491-4508. And more importantly, we've got other webinars coming up throughout the month of April and May. Of course, we have this regular monthly ClearVista Financial Perspectives on the first Thursday of the month at 10 a.m. If you're a client, you'll get a copy of this in the April or mid-month email that we send to all clients. But visit us on the web at ClearVistaFinancial.com. That's ClearVistaFinancial.com. You can see some other videos that we've done and other recordings that we've done in the past. And you can also read some of the articles and blog posts, stuff like that.
Yeah, but otherwise, thank you so much for being a part of our event, and we hope to speak with you soon.
All right. Thanks for joining us today.